Welcome to the Brainless Investor YouTube channel. By the end of this video, you'll be able to differentiate between a loan and a debt. First of all, let's look what does a loan actually mean. A loan is a specific type of financial arrangement where one party, typically a bank or a lender, gives money to another party, the borrower, with the agreement that the money will be paid back over time, usually with interest. A loan may be secured by collateral such as mortgage, or it may be unsecured such as credit card. Lenders will consider a prospective borrower income, credit score, and debt level before deciding to offer them a loan. Key features of a loan. It has a formal agreement or contract. Repayment is structured, such as monthly installment, often used for a specific purpose. Example, home, loan car, student loan, including interest charges, the cost of borrowing. Example, you borrow $10,000 from a bank to buy a car. You agree to pay it back over 5 years with 5% interest. That's a loan. There are four components of a loan. The first one is a principal. This is the original amount of money that is being borrowed. The second one is loan terms, the amount of time that the borrower has to repay the loan. The third one is interest rate, the rate at which the amount of money owed increases, usually expressed in terms of an annual percentage rate, or known as APR. And the fourth one is loan payments, the amount of money that must be paid every month or week in order to satisfy the term of the loan. It is based on a principal, loan term, and interest rate. This can be determined from the amortization rate table. Now that you've understand the components of a loan, let's look at the types of loan. The first type we'll be looking at is secured loans. Mortgages and car loans are secured loans as they are both backed or secured by collateral. In these cases, the collateral is the asset for which the loan is taken out, so the collateral for the mortgage is the home, while the vehicle secures a car loan. Borrowers may be required to put up other forms of collateral for other types of secured loans if required. The second type is unsecured loan. Credit cards and signature loans are unsecured loans. This means they are not backed by any collateral. Unsecured loans usually have higher interest rate than secured loan because the risk of default is higher than secured loan. That's because the lender of a secured loan can repossess the collateral if the borrower defaults out. Rates tend to vary widely on unsecured loan depending on multiple factors such as the borrower's credit history. The third type of loan is revolving and term loan. Loans can also be described as revolving or terms. A revolving loan can be spent, repaid, and spent again, while a term loan refers to a loan paid off equal monthly installments over a set period of time. A credit card is unsecured revolving loans, while home equity line of credit (HELOC) is a secured revolving loan. In contrast, a car loan is secured term loan and a signature loan is unsecured term loan. Now that we've understand what is a loan, let's understand what's a debt. A debt is a broader term that refers to any money that is owed by one party to another. A loan is just one type of debt. Debt can be secured or unsecured with fixed date or revolving. Corporations can also issue debt in the terms of bonds to raise capitals. The key features of debt are can include loans, credit card balance, unpaid bills, doesn't always have formal structures, can be short-term or long-term, may or may not even have interest depending on the type. For an example, if you owe money on your credit card, have unpaid utility bills, or took personal loan from a friend, all of that is considered as a debt. There are three components of debts. The first one is principal, the original amount of money borrowed. The second one is interest, the cost of borrowing expressed as a percentage of the principal amount. The third one is fees, can include origination fees, late payment fees, or other charges associated with the loans. Now that you've understand the components of a debt, let's look into the types of consumer debt. The first type of consumer debt is secured debt. Secured debt is referred to collateralized debt as well. This indicates that the borrower has offered an item of worth to support the debt. With a car loan, for instance, the automobile typically acts as a collateral. If the borrower does not repay the funds they took out to purchase the vehicles, the lender has the right to take it back and sell it. The second type of consumer debt is unsecured debt. Unsecured debt does not necessitate any collateral for security. Rather, the lender determines whether to approve the loan based on the borrower's creditworthiness, as shown by the credit score, credit history, and additional factors. Most credit cards and most personal loans serve as example of unsecured debt. Since unsecured debt tend to be more hazardous for the lenders, it typically requires a higher interest rate compared to secured debt. Now let's look at the third consumer debt, which is revolving debt. Revolving debt offers the borrower a credit line that they can utilize as desired. The borrower is able to draw a specific limit, repay the debt, and then borrow up that limit once more. Credit card debt is the most prevalent type of revolving debt, provided that the borrower meet their responsibilities, generally by making minimum monthly payments. The credit line stays accessible for the duration of the account's activities. Over time, with a positive repayment record, the amount of revolving credit accessible to the borrowers could increase. The fourth one is mortgages. A mortgage is a kind of secured loan utilized to buy real estate like houses or condos. Mortgages are typically repaid over extended durations such as 15 or 30 years. Mortgages frequently represent the most significant debt aside from student loans that individuals will ever incur, and they are available in various forms. Two main types are fixed rate mortgage and adjustable rate mortgages, commonly referred to as ARMs. For ARMs, the interest rate may alter at interval, generally depending on the performance of a specific index. Now that we've understand the type of consumer debt, let's move on to the next kind of debt, which is corporate debt. Corporate debt is usually known as bonds. Companies seeking to borrow funds have options that aren't accessible to individual consumers. Beside loans from banks or other lenders, they often have the ability to issue bonds and commercial papers. Bond serves as a debt instrument, enabling a company to raise capital from investors by agreeing to repay the amount with interest. Both individual investor and investment firms can buy bonds, which usually features a fixed interest rate or a coupon rate. If a company needs to secure 1 million to acquire new equipment, for instance, it could use 1,000 bonds with each face value of $1,000. Bonds generally come due to a specific date in the future known as maturity date, at which point the investor will obtain the bond's entire face value. Furthermore, the investor will have received periodic interest payment throughout the years lending up to the date. Commercial paper refers to short-term corporate debt with a maturity days of 270 or fewer. So now let's summarize the difference between loan and debt. The definition of a loan is a formal agreement where money is borrowed and repaid with interest over time. It's usually formal with a contract or an agreement. The types of loan is personal loan, home loan, car loan, or student loan. Repayments term fixed or structured schedule. Example, monthly payments. Interest is usually charged all the time. Depends, right? Lender involved, typically a bank or financial institution. Example, borrowing $20,000 from a bank to buy a car. Legal documentation, yes, legally they have binding agreement. So a debt, the definition of a debt is any amount of money owed by one party to another. It can be formal like loan or informal like unpaid bills. The type of debt is loans, credit card balances, bills, mortgages, and all. Repayment terms may or may not have fixed repayment terms. Interest, sometimes they're charged. Example, if you pay late for a credit card debt, they get charged probably 15, 20%. Sometimes not, depending on what kind of debt it is. Lenders involved could be bank, companies, individual, or service providers. Example, owing $1,000 on a credit card plus $100 in unpaid phone bills. Legal documentation, not always, depends on the source of the debt. Thank you for watching this video today. If you liked it, please leave a thumbs up and subscribe to our YouTube channel.